Let's talk about picking tops and bottoms in the market. You know why? Because picking tops and bottoms, after all, is one of the most coveted skills in all of the financial world. It doesn't matter whether you are a short-term trader or a long-term trader like Warren Buffett. Your ability to consistently pick major tops in the market and to find the areas that turn out to be major lows in the market is one of the most valuable skills you can ever accumulate in this business. My ability to fairly regularly pick a top and bottom with precision and the utmost accuracy. And this skill is the most coveted skill of all.
The technique that I'm going to share with you today, I've been using for the past 25 years or so. It has proven to be not only reliable for me, but it's proven to be reliable for hundreds and hundreds of my traders. And if anyone who's followed my work for even a little bit of time, you know that, there have been some fairly accurate calls for market tops, such as back in February, March of 2020, as well as major bottoms in the market, such as the Bitcoin bottom in March of 2020. And so I'm going to share with you the very same technique that I use to grab the secondary component of a bottom. And I'll explain that in a little bit more detail as we get into the presentation. The inaccuracy comes at picking the first part of the bottom, but the second part of the bottom, you can have a very high degree of accuracy. So we're going to focus on the second part of the bottom today. How to pick bottoms in the market. Now, the first thing we have to cover are the tools that we need, okay? We need some very basic tools, 3 in general. We need, number 1, a candlestick chart. Now, there are a variety of different styles of charting, guys, but I believe that the candlestick form of charting really appeals to the trader in a more powerfully visual way. And if we're charting or approaching the markets from a technical perspective, a lot of what we rely on is visual interpretation. And I believe that no other charting form offers the benefits of that of getting your visual interpretation correct more than the candlestick form of charting. Okay. So we're looking at candlesticks, right? The second thing we need is we need a 20 period simple moving average of that chart. Okay. Now, I will say that for this technique, I will be showing you predominantly the technique off of a 2-minute time frame, which is a short-term oriented time frame, right? Each bar represents 2 minutes of trading. We're looking at Tesla now, and each bar represents 2 minutes of trading. Now, a 2-minute time frame is predominantly for a very active, almost micro form of trader. We're looking to take gains anywhere between over 8 2-minute bars to as many as 16 2-minute bars. So 8 to 16 bar time frame. I will say that the technique I'm going to share with you today is applicable in every time frame. So if you prefer a 5-minute time frame, the technique works. If you're a longer term player and prefer a daily time frame, it works. Or an even longer term time frame, a weekly time frame where you're more investor style, it works. And I'm going to show you briefly that today. But for the benefit of teaching you, for the purposes of teaching you, I will be using the 2-minute time frame where I have hundreds of traders each day applying this technique to the 2-minute time frame, okay, for daily market gains. So we need the 2-minute chart, a 20 period moving average, simple, all right, of that 2-minute chart. And we need a 200 period moving average overlaid on that chart as well. So these are the 3 primary things: the chart itself, the 20 period moving average, and the 200. All right, there are many things. I could literally talk for hours on this one chart. There's so much to see and benefit from. All right, but that's for another time. We're going to keep to the topic of picking bottoms. Now, a lot of people ask me about volume. Volume is optional. I believe that if you want volume on your chart, you can put it on there for visual appeal. You won't really be truly using volume if you're following my trading techniques, because my techniques help you become the volume that other people read. And let me give you a quick example of that, okay? My traders know that this bar right here is what I call a clearing elephant bar. That is a buy. All right. So it's a powerful green move that is trading above a chunk of former price data. So here's your former price data, and we're moving out of a chunk of former price data, almost like a flagpole or a taller building than the rest of the buildings to the left of it. That's a buy. Now, my traders are taught to dive into that bar, that they're not to wait for that bar to finish, that as soon as, all right, as soon as this bar clears, they're to buy there. Okay. Now, if you look at the volume here, the volume surges, which is a powerful sign. However, you don't know what that volume bar is going to be unless you let that bar finish. Well, as far as I'm concerned, buying after the bar here, it's okay, but it's definitely less beneficial than buying as soon as the break occurs. And so we can't wait for volume all the time to confirm our buy. We look to actually help form the volume that other traders look at after we're already in, and their subsequent buys help lift us higher, right? So we're not heavy reliers on volume. And in addition to that, traders, I will tell you that volume used to be incredibly more important when I first got in the game back in the mid 1980s, early 1990s, but gradually volume became more and more irrelevant due to the fragmentation of the markets. Black pools and gray pools of liquidity now are responsible for a lot of the volume, where the volume gets reported much later. That's why they call them dark pools of liquidity, gray pools of liquidity. Institutions push their orders through those pools. Those pools don't report the volume until much later, so that during the day, you're not really getting a true representation of volume in the first place. Okay, now that we have the tools, the chart, the 20, the 200, volume, if you like, let's go over the technique. The 20, and I call this technique the 20 period moving average halt technique, as in halt, who goes there, as in stop. Okay. Now, the first thing in order to pick a bottom is that you need a decline. You need a stock or any item that you trade to be declining, and you preferably want a very thorough decline. This tactic is less reliable if we're talking about mild pullbacks. I'm not talking about picking local bottoms. I'm talking about picking the bottom, okay? The bottom after an elongated move down, the bottom after an extended downtrend, not the local bottom within an uptrend. There are two types of bottoms: local bottoms and V bottoms. We're talking today about V bottoms, okay? There's a very, very steady move to the downside. So we've got the decline. I'll explain something here about the declines. When I see a thorough decline, a multiple bar after multiple bar after multiple bar decline that has distance from its moving average, I start getting interested in possibly looking for the bottom. What do I mean by distance? I am talking about distance from, okay, let me grab my pen here again, distance from the nearby 20 period moving average. Now, if I were to draw a line straight to the chart to the actual price now, there is great distance between the two. The best bottoms form from a distance away from that 20. Not all of them, but the very best ones statistically are far from the 20. Now, I'm going to even improve on that. If the stock itself is far from the 20, and the 20 is also relatively separated from its mother, the 200, we have what I call dual space. Space 1, space 2. A dual space bottom is the most powerful bottom of all. It is the number one technical sign that the sellers have largely gotten all of their selling or most of their selling done. Now, if you look to the left very, very, very quickly, you'll see that if you try to pick a bottom too early and you don't have that great distance, the odds are much lowered for you. But the things that I look for is an elongated drop. So here's the beginning of the drop, and here's the drop to here. So we've got an elongated drop. This is not a short drop, it's an elongated one. And so if the sellers had ammunition, bullets to sell, you have to imagine that their guns that they're selling with, boom, 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 can't still be that full of ammunition. That the move is so deep and so elongated that most of the selling is probably done. Okay. And we confirm that it's highly likely with dual space. Now, we don't need dual space. The dual space is the optimal situation. You only need really one space. But if you got two, wow. The first thing is the decline. That same decline, the next thing we need is a move up through the 20-period moving average. So remember, the first thing we need is the decline, elongated decline, preferably with space, preferably with dual space. Then we need, number two, a move through the 20-period moving average, not to the 20-period moving average, through the 20-period moving average, okay? We need this, the move through the 20. Now, you can come to the 20 and drop, to the 20 and drop. That's not what I'm talking about. We need the move through the 20. That's the second criteria. First, we need the decline, elongated, preferably with space, really preferably with dual space. That's one. Number two, we need now to see if the stock is capable on its next rally of going through the 20-period moving average, okay? So Lucid did just that. Now, the third thing we need is that the next pullback after going through, we want to see if the 20-period moving average halts it. We want to see that now that the stock is above the 20, does the 20 catch the stock on the way down? That's the 20 MA halt. Or does the stock just ignore the 20 and continue lower? If the 20 catches the stock, that's when we start to salivate. This is catching the secondary bottom. You see, the first bottom is here, the dual space. And we have techniques, I have techniques with my traders to try to capture that first bottom. But the second bottom after the bottom is far more reliable, okay? And that's what we're focusing on today. In this case, the 20-period moving average did catch it. There was a brief slip, but that's okay. That's more like leaning on the 20-period moving average, like boxing ropes, but not breaking it. We come right back. We lean against the 20 and come right back. So the 20-period moving average caught it. After the catch, what you need is for a green bar to take out the high of a solid red bar. What's the most recent solid red bar? It's right here. You see that? Now, now that we have the halt, as soon as the first time a green bar trades above, I'm going to erase this so you see it clearly. Once a green bar trades above the high of its most recent solid red bar, boom, no questions asked. You don't wait for that green bar to finish trading. You don't doubt. You don't hesitate. You don't call the psychic hotline. All right. You don't seek for anything else. You just hit the darn buy button and immediately protect yourself. Here's how we protect ourselves. We're going to go under that halt. We're going to go under that halt. So wherever the halt happened, we're going to put a protective stop under the halt. Okay. Now, it should go without being said that you should know how much you're going to lose should it not work. This you should know before you take the trade. But that's a different topic. But just to mention that, no professional trader goes into a trade without knowing I'm not going to lose more than this. So you got to know where that stop is, and you have to be able to calculate if I buy here with X number of shares and it does not work, I will lose X, which is okay because X is not more than what my plan dictates is my maximum loss per trade. Every trader needs a maximum loss per trade. We've got the halt. Remember the items. We need an elongated decline. That decline preferably should have space, one space, but really preferably two spaces. If we've got an elongated decline with either one or two spaces, the next thing that needs to happen is the stock needs to move to demonstrate its ability to not move just to the 20, but sear through the 20. Now, once it sears through the 20, now we're watching closely. How does the next pullback fare? And if the 20-period moving average catches that next pullback, the plan goes into play. We grab the most recent red bar, we mark off the high, and if a green bar takes out that high, boom, protect ourselves under the halt. Now, some traders might ask, well, Oliver, what if it just sears through the 20 and keeps going? Well, that's life. You missed the train. Have you ever missed a train in life? Yes. Missed a bus, missed a taxi, miss your ride. It happens. It's life. Move on. It's not yours. We only want the ones that demonstrate a 20 MA halt. All right. My father used to tell me, many of my traders know this story. My father used to sit down at the dinner table and tell me when I was a teenager, Oliver, stop chasing every single dollar in the world. Every dollar is not yours. There are some dollars that belong to other people. You have to carve out which dollars in the world are yours. This keeps you focused, Oliver. This keeps you knowing what to do. This prevents you from being distracted because if every dollar in the world you want to chase, you'll never get roots. You'll never settle down. You'll never focus. And this is what I'm constantly telling my traders. This move is just not ours. The dollars we've carved out for ourselves are the ones that come back to the 20 and halt. Those are our dollars. And there are plenty of them to take advantage of. Okay, good. Thank you very much, Dad. Thank you. We've got the halt. Boom. Now, the initial run. I'm not finished. On this initial run, if it's decent enough, if the move is decent enough to, let me show you, if the move is decent enough, I have no problem with my traders taking profits. What's decent enough? If you get a decent enough space away from the 20 that halted the stock in the first place, there's nothing wrong with taking profits. But I want us to try to take advantage of the secondary play, which is the next 20 MA halt. You see, the first one often leads to the second one, and sometimes the second one is bigger. So we've caught the first halt. There's another halt that's highly likely. Highly likely. I have no problem with taking profits. I try to tell my traders, if you're going to take profits on that first one, don't take it all because we really want to add to the play if there is a second halt. So the halt play is not just one halt, it's two halts. Keep that in mind. It's not just one halt, it's two halts. Now, let me clear the drawings here and boom. Now, boom. I don't know if you can see that, but we shoot really nicely high from this 20 MA halt. This is today, guys. I always try to show you things relevant. I don't want anyone to accuse me of going back in the past and cherry picking. This happens all the time in the market. So we get that first halt, boom, trade above the red, protect ourselves below the halt, and I love that sound, by the way. Do it. Do it for me. You know how to do that? No, I know you don't know how to do it. That's why you're here, but we'll get you there. Okay, teasing it. Here is where I do want you taking profits. If you're going to take, remember, space in the market is an action. We had space to the downside and action, space to the upside away You got to act on these wide spaces, right? If you're not a wide space actor, the odds are against you for success in this game. The secondary drop, here's the pullback to the 20. If the 20 halts it again, you're in likely for the secondary run. Now, sometimes it's the secondary run that's bigger than the first one. This is going to be hard to match because this first one run here was big, but oftentimes it is your second run that's bigger than your first run, which is why I don't want my traders not taking advantage of that second opportunity. It might not present itself. That second drop might just shoot through. Okay, it just shot through. But if it doesn't, I want us ready. And in this case, it doesn't. Boom. We halt at the 20 for the second time, and green takes out its most recent red. Boom. What do? Protect ourselves under the halt. And as you can see, boom. That's the second halt. This is the second halt. This is the first halt. Here's the second halt. And there's your space. Space above the 20, you must act. Anytime you have space, wide space above the 20, you must act. It's relative, I understand, but if you're intimate with the stocks you play, you'll know what's wide for those stocks or the financial items you play, because this strategy works on every financial instrument out there. Let's take a look at one more here, Roku. This is from today as well. Okay, Roku opens up today, briefly moves to the upside, and then goes into this elongated, there it is, the elongated trend to the downside. Now, remember when I told you we just need space. We need an elongated move down and we need space, but preferably dual space. Well, here is no dual space, but we have space. What do I mean by one space? The separation between 20 and 200. So that's the first space. Remember on the previous slide, right? I showed you that here we have space. We have two space levels, and I made this one and that two. That's on purpose. It's not inverted. The first space is always the space between the two moving averages. The second space is between the stock and the 20. Okay, keep that in mind. It's very important. All right. It sounds like it's not important, but it is. And I'll explain it to you right now. So here we have an elongated move to the downside. That's criteria one. Part of that criteria is we need space, preferably dual space, but if we don't have dual space, we need one space. One space, remember the number one is between the two moving averages. Number two space is between the stock and the 20, okay? So here's number one space here, one. We don't have wide space between the stock and the 20. So we only have one space, but that's okay, right? Two is super ideal, but one is workable. So we've got one space here. Now, what's the second criteria? Once we have this elongated move to the downside with space, we need to see the stock demonstrate its ability to sear through, not just come to like it did here. It came to and dropped, came to and dropped. You see, came to the 20 and dropped. No, this sears through. So the very act of searing through the 20 is telling you that the stock is demonstrating qualities of change. It's suddenly gathering some extra ability to do what it wasn't able to do. How many times? 1, 2, 3 times before. So why is it all of a sudden that this stock is now capable of doing something that it failed at 3 times? It's going through change. It's ready for change. We sear through. The next thing we need to do is we need to carefully monitor that pullback. Now, remember, these dollars aren't yours if it does that. Okay? Remember my dad's lesson. Every dollar is not yours in the market. Don't chase every dollar. Focus on defining your dollars. The dollars we're going to make is if this stock pulls back to the 20 and halts. Okay. And let's see if that's what we have here. Boom. We get that pullback. Beautiful. This looks beautiful. Pull back to the 20. We halt. And the first time a green takes out a solid red. Now, some traders do it above the little reds. The best ones come when they're taking out somewhat of a solid red. Your solid red here is here. Look at this. This took out the solid red too, but it wasn't enough lift above the 20 for me at that point. It needed more lift. This is the lift. This is the searing through. Now, this pullback is the ideal one. Wow. See that green take out that red? Boom. Don't remember what I told you. Do not wait for this green bar to finish. As soon as it clears, it could still have another minute left in the bar. Who cares? You're in it already. I don't want you waiting for that bar to finish, because what if that bar finishes up here and you've missed the trade? We're getting in right above that red line. You don't doubt. You don't check something else. You don't try to seek verification. You don't roll bones. You don't call up the hot psychic hotline. You don't call up your trader friend to ask him to look for it. You just hit the button, all right, with certainty. I like bold, certain traders that when the action, I want to see who you are when the moment that calls you into action. I want to see who you are at that moment. Do you hesitate? Do your palms get sweaty? Does butterflies start or elephants start jumping up in your, do you seem uncertain? Do you shy back? Do you play ostrich? Do you put your head in the sand and pretend that it didn't happen? Or do you become bold? Do you leap into action without a shudder of doubt? Is your action pure and full of power and certainty? These are the things I want to see when the market calls you into action. What kind of soldier are you? And so I want it done with certainty. Now, once you're in, stop. Your protective stop is below the halt. We got a very low risk opportunity here. Now, I'm always saying the minimum target you should try to go for, you might not get it, is the 200 period moving average. All right. And sometimes we can break through on the secondary one. But let's see if we can get to the 20, back to the 200 period moving average there. And so if that happens, your profit is this and your risk is that. How many of these little risk amounts fit inside of this profit amount? And if you can keep the ratio like that, you will stay in this game forever. You're going to do extraordinarily well. Boom. What happens here? Something interesting happens here. All right. The stock flirts with your stop. Let me talk about this. My traders are taught to take a 2-bar stop. So their stop would be there on the second bar. So oftentimes a stock might slip marginally below your stop level and come back. So we have a 2-bar stop rule. All right. But we do get some sort of lift here after the buy. Boom. Now, don't think that that's small, guys. That move there looks like it is, it's like $1.20 or something like that. That's not a bad move. 1,000 shares gets you $1,250. We pull back, we go through the 20 again. But do we, on the next attempt, do we at some point get a secondary? Do we get a decent, see, this move is not decent enough to consider a sear through, see? But this move gets height. I need height above the 20 and then come back. Give me some height above the 20 and let me watch that come back. You see, we got height here and it's seared back through, okay? But we get height again and we get another halt. And here is your solid bar. And there is your buy. Once it clears, once any green bar clears the solid bar, you don't see, if you wait for this bar to finish, you're going to buy here. And that's wasting too much money. That's giving too much money to the market. We're going to buy here. Plus, the closer you buy to your entry, the closer you are to your stop. So it's actually safer than waiting. Some people think that waiting for confirmation is safer. No, it's risky. It's extra confirmation costs money, just like extra insurance costs money. You want extra security costs money. You want something extra in life, it costs you money. We don't need the extra with this. So we're going to keep the cost small. The cost here is small because my stop is here. But if I were to enter here, my stop has to really be the same. So that's my cost. It's too big for me. Okay. And we get lift. We get lift. All right. We should be taking some off the table. Anytime you get lift, you can take some off the table. I have no problem with that. Anytime you get lift away from the 20, we can act. You can never go wrong doing that. Okay. So that's the 20 MA halt, guys. Elongated decline plus space, preferably dual space. Then we need to see the stock get seared through the 20 and get lift above the 20. We watch that next pullback. If the 20 MA halts, we grab that most recent solid red bar. Boom, we buy above the high of that red bar. We protect ourselves against under the low of the halt, and we look for moves away, and we monitor to see if there's going to be a secondary halt in the play. Okay, beautiful, beautiful strategy. I've been using this for 25 years, guys. Now, just to quickly show you that this is not just a micro trading strategy, I want to show you a couple big time frames and then we'll close out, right? All time frames work. All right. Here is an example of, I think this is the oil index, right? So we're below, look at the stock trend down a bit. Now we're not under the 200, but we're definitely trending down from this local top here. We're trending down. The stock gets below the 20 with some degree of space. We get above. I would really have liked to have seen this get a little bit higher above the 20, but boom, we pull back and this solid bar clears these multiple reds there. So sometimes when I don't have a solid bar to work with, I want to see a green bar clear 2 or 3 of the little ones then. So this green bar clears all 3 of these little ones. So I'm looking at those little ones as one solid bar chopped up into 3 pieces. Okay. And so boom, buying into that bar, protection under the halt. The rest is history. That's looking at, this is a daily time frame. This is a daily chart. Now, if I go to a weekly time frame, you can see it in Snap. Now, sometimes in a weekly, the events that you're watching happen a little further apart in time, right? So here we're under the 20, we get lift above the 20, we pull back to the 20, and this bar right there clears out multiple little reds. So when I don't have a local solid red, I'm okay if the green bar clears out several little reds. That's the same event to me. Boom, right there, 20 MA halts. Protect yourself under the halts. And as you know, when you start to get distance away, you want to take profits. And there you are on the weekly time frame. All right, the same thing. Get rid of these things here. Boom. You can do this. This is not rocket science. I believe that there has been historically this false narrative that has been promoted in terms of market play to the general public in particular. And it was a tactic to sort of keep regular people out of the game, to deny access. This was an historical way to create separation amongst people, right? To deny access to my private club, to deny access to my market, to deny access to my neighborhood, to deny access to my schools. All right. It's just part of history. The markets had this, where it was sort of like a private club, and the barriers to entry were high. Technology helped to bring those barriers down. The lowering of interest rates helped to do that as well. A variety of things helped to create the advent of the internet came into existence to lower barriers. And but this notion, despite the fact that now virtually anyone can gain access to the financial markets, gaining access to the proper knowledge is still not very easy. And also, despite the fact that most people can have this access, most people are operating in the markets without the proper training, without the proper guidance. And I'm here to tell you guys that you can't do it that way. It doesn't come out of the sky. It doesn't come from watching YouTube videos, even mine. They can be helpful, but you can't learn how to trade from YouTube videos. You can't learn how to trade from reading books. You can't learn how to trade from going to traders expos. Those things can serve as a really solid foundation for learning. You can't learn how to be a doctor in medical school. The medical school, the education, sitting in lectures, taking notes, memorizing Latin, taking exams, those things are necessary for the doctor, but they don't make the doctor. And so I find that a lot of people are stuck in trading medical school and they think that's enough. It is never enough to know what to do, because knowing what to do is no guarantee that you do it. Most people think that education is all they need, which is knowing, but you have to make the knowledge yours through training. And it's the training part, not the education part. Education today is free. The advent of the internet made it free. The demonetization of value today that's going on, this era, has made education free. Today, I can hold an entire library, multiple libraries in the palm of my hand. So education has become dematerialized. It's become digitized. Education is free. Certification is not free, but education is free. But if you need a certification, you're going to have to pay for that. But the education being taught to get the certification, that's free today. Knowledge is free today. Thank God for the internet. Thank God for this new digital era. But what can't be digitized, what can't be dematerialized, what can't be skipped is training. A doctor needs training to become a doctor. Medical school doesn't cut it. The education is not enough. And so many people are out in the markets thinking that, why am I not doing well when I know what to do? But that's the knowledge part. You're missing the training part. And the training part is the experience building part, because your success is on the other side of your experience. It's not before experience. Any success you get before experience is luck. Your success, real success, comes on the other side of experience, and experience takes time. How do you gain experience? Through training. You have to take the knowledge and grapple with it, fall with it. You have to work with it. You have to make it yours, because one thing I will tell you is that you can't trade my knowledge. You can't trade my experience, but you can take my knowledge, you can take my experience and make it yours through your training. Training is the process of converting knowledge into experiential power. And it is only after that transmutation occurs that you can start to see the fruits of your labor. It will never come by just simply knowing. It is not enough.